Yo, what's going on? I'm sitting out on the deck of one of my favorite places to be out there, my place in Missouri. There is a little bit of traffic going on in this particular road out in front of here, construction going down the road, but still gonna be out here. Got to have breakfast outdoors, listen to the critters going on, the nice, crisp, clean Ozark air. There's parts of it probably ain't that dang clean, but this particular area is pretty dang nice. So, wanted to go over the market where we're at today. Go from Friday to Friday. Let you know what happened this week. Give it a little bit of a breakdown on that. I'm going to look at it from a little bit of a perspective of some of the other traders and how they write it up, rather than going off my own perspective here. Because you got Monday, which opened fairly soft. The mortgage-backed securities slipped just a little bit, with the 10-year pushing those yields to that higher point. A little bit of light data. Markets trading in a little bit of position of risk, but keeping everybody vigilant and floating with most of their locks. And then on Tuesday, some tension started to build, right? We have the 10-year pushing that resistance. They had a little bit of a modest recovery. Yields retreated a bit as far as the 10 year is concerned. So it, kind of started anything into a little bit of a downward trend, hitting some sort of resistance. Now, there is a bit of a sideways grind that we're starting into. So there's no major releases here. Bonds are kind of in a no harm, no foul zone. Traders are debating, from what we understand, whether the trend will break sideways and continue to grind a little bit lower. Now, I was thinking we might get a little bit of a lower push, but sideways is starting to prove out. The 5.5 UMBS is adding another, couple of ticks on Wednesday, just little bits of movement, not a lot of movement there. And they're in their 12-month high supporting Fannie Mae's outlet for what those rates could be by the year end. Now, Treasuries bounced lower inside the downward channel, but MBS coupons moved less dramatically than those yields in Treasury. So when everybody says Treasury, they looking at the 10-year a lot, as I keep saying, they're not always going to be the same. Now, Thursday had a little bit of reversal. Jobless claims disappointed what people thought was going to come in. MBS went down just a bit. Well, then we had the Fed bias kind of weighing in a bit. The minutes say the inflation has inflation emphasis overpowering soft labor and PMI data. So the market's shifting pricing in line with what the Fed's hawkish lean might be, eroding those gains we had on Wednesday. But, the week's takeaway, despite those swings, the UMBS 5.5, which is what I'm always staring at, however, just below that level that I keep showing. I'll show you what that level is here. And it's hasn't really defined a channel yet. I think it's going to more define kind of a sideways movement. And let's take a look here at what I'm referencing with that. Because as you've seen, I've got this box egg created here, right? So here's this block, if you will, where we're going to see that trade within that. We trade out of it, and it wanted to get up here to that point that was created back during quantitative easing. But because those news that we were talking about that pushed it back down, we lost some of that ground. We're sitting here right here. We're bouncing across the top of this. It's kind of almost like it's wanting to knock its way out, but doesn't have the strength. It's also swung back down as far as low as this particular support we have here. That should be a blue. In reality, I should be changing these as we see them. It's red when we're resistance, blue when we're support. So we got support right there. It's hitting the support and it's hitting on top of this. So I think it's going to continue to trade sideways, maybe in this for this foreseeable future, unless there's big enough news to push us out. So that's the week in theory, but where we sit, when you look at what's going on with mortgage-backed securities for the last couple of years, guys, look at this. I'm going to condense this all down to where we're looking at. Let me see here if I can squeeze this a little bit more. Oh, sorry, shouldn't have moved that. Can't see it real well in this. My screen is not as easy to see for me to come outside here. So now we're going all the way back. This takes us all the way back here for a couple of years. Look at this. We're about at the peak. If you start looking for all these peaks are pulling back, pulls back, pulls back, pulls back. We're at the peak here. We're just below that peak area by about, let me see here, that peak area is about 100.23. I'm guessing we're right now at about 100.3. So we're up 20 basis points, guys. In reality, we're 20 basis points off of those peaks. So we're at that best interest rate scenario. I don't know that we're going to see them get that much better. If we're holding out for them to get better, you're nuts. And if you think they're going to get better because of what the Fed does, that's crazy too. Let's just go ahead and just keep moving forward. Find those properties that make sense. We've been showing them to you. There's a lot of them out there. There's more coming. I'm just watching to see how a couple of these do, and then I'm going to try and barrage you with some good stuff. Pay attention. See what's out there, look around, set your baselines, know what you're looking for. If you don't know what those baselines are, call me and we'll talk about it. Get you set up correctly. Appreciate you guys. We'll talk to you on Monday. No, Tuesday.